I'd like to welcome all those logging into Money Show's Virtual Expo, your 2026 portfolio review. We have about 3.5 or so minutes before the start of the next session. So sit back. We'll be right back with you momentarily. Thank you so much for being here. All right, Christina, we're getting ready to start here. Welcome back, everyone, to Money Show's Virtual Expo, your 2026 portfolio review. We are pleased to welcome Christina Hooper, who's a chief market strategist at Man Group, where she provides views and insights on the economy and markets. Christina was featured on the cover of Kiplinger's magazine and has appeared regularly on CNBC, Bloomberg TV, Yahoo Finance, and Reuters TV. She has also been a main stage speaker at numerous national and regional conferences. Christina has regularly been quoted in the Wall Street Journal, Financial Times, the New York Times, Reuters, and other financial news publications. Christina, thank you so much for being here. It's all yours.
Thanks so much, and thank you all for joining me today. Well, the macro environment markets are so fluid that today I'm actually going to dispense with slides and really just walk you through my views on the 2026 outlook for both the economy and markets. Many of the themes that I talked about for 2026 are already coming to fruition, some more than others. So I'll talk a little bit about that. And of course, investment implications. So if I were to think about the world in terms of key themes for this year, one would certainly be monetary policy fragmentation. And what we have seen over the course of the last several years, and particularly in the last year, that I think will only be amplified in the coming year, is more fragmentation around monetary policy decisions, especially after tariffs. Central banks really looked inward to make their decisions. And what we've seen is that some economies have greater concerns around inflation and being able to tamp it down than others. The Eurozone has been able to bring down inflation levels very close to target. The U.S. is not as close to target, which is why the Fed remains somewhat concerned about that issue. So I think we'll see a lot more differentiation, certainly in terms of monetary policy going forward, as well as monetary policy tools. Certainly, the Bank of Japan is in an unusual place. Arguably behind other central banks in terms of normalizing monetary policy, and it is a big lift. So we're going to see some very different moves coming from the Bank of Japan than, for example, other major central banks. So again, suffice it to say that we'll see fragmentation. I do believe we haven't yet seen the resolution, of course, of whether or not the Fed is able to maintain its perception of independence. I do think that that we'll get a Fed chair that likely will reassert that independence, but there's still some question marks there. And there's certainly challenges to Fed independence. So we just also want to stick a pin in that and remember that as we go through the year in terms of what could also be a driver of some monetary policy fragmentation. Another key theme for me is fiscal sustainability or the lack thereof. What we're seeing is increasingly concerns about economies taking on too much debt. And one of my favorite money show presenters, perhaps the favorite, is Dr. Ed Yardeni. And back in the early 1980s, he in fact coined the term bond vigilantes. And I'm going to read you his exact quote. "If the fiscal and monetary authorities won't regulate the economy, the bond investors will. The economy will be run by vigilantes in the credit market." Now, we have seen different periods of time where bond vigilantes have come out, but not in really huge force, especially not for the United States. And that could very well change this year. Now, one of the interesting things that we have seen is that markets tend to worry about fiscal sustainability in another economy if they see it appear in a different economy. Probably could have worded that better. So, for example, we're seeing right now in Japan, there are concerns about rising deficits because of Sanae economics, which is the approach that the new prime minister has, which is spend more to juice the economy. And they could also very well see lower taxes. So that could cause a larger fiscal deficit, which could mean, I should say, that yields on the long end could go up. We've already seen a reaction over the last 6+ months where yields have gone up on the long end. And that has caused investors to then scrutinize other countries and their fiscal deficits. It's just something that happens. And of course, we have fiscal sustainability issues in places like France, the UK, and the US, because we are seeing widening fiscal deficits as well. That has very significant implications because historically, when yields have gone up on the long end, they have exerted downward pressure, oftentimes on stocks. So it's something to keep in mind. It's not just a bond market issue, so to speak. Another important theme is the rise of the visible hand. And by that, I mean that we're seeing more economies, especially developed economies, get involved, governments get involved in the private sector. Now, it used to be that industrial policy was the province of emerging markets countries. But in recent years, we've actually seen more industrial policies coming from developed countries. And that has significant implications. I think about an old quote from Ronald Reagan. I don't think he thought about it in this context, but he said the 9 most terrifying words in the English language are, "I'm from the government and I'm here to help." And certainly not trying to disparage the government. In many cases, we absolutely need it. But I will say that sometimes it can be problematic to have a government that's very involved in the private sector. Sometimes it can go well, but there are risks in that. And so what we're seeing is more countries' governments get involved, promulgating industrial policy, getting more involved in the private sector. And we're seeing that in the US as well. The US is taking ownership stakes in companies. We're seeing more in the way of involvement. For example, capping, the idea of capping credit card interest rates. All those things could be positive for certain groups like consumers, but it can have some unintended consequences. So we just have to recognize that risks, or at least the potential outcomes, have gone up. And at some point, there could be some deterrence in terms of investors wanting to be in truly laissez-faire markets, or what they perceive to be laissez-faire markets. Another theme that we've seen is just greater income and wealth inequality. And that can have ramifications in voting booths. That can certainly cause pendulums to swing from one side to another. And so I think we have to just recognize also that when we have greater wealth and income inequality, much more of the economy is riding on a smaller portion of consumers, especially in a country like the US that is so consumer driven. And then the final theme that I would argue that we're seeing right now is around AI. And it's that question mark about whether or not we'll see creative destruction. In other words, more opportunities created by what AI is doing, or if we're just going to see destruction, and in particular, destruction of jobs. I think that certainly will add to uncertainty. We got a consumer confidence number today that was the lowest we've seen since 2014. And I think that underscores that there's nervousness about the economy. And I think some of that, at least some of that, has to do with concerns around AI and how that will reshape the economy, and especially potentially create structural unemployment that's quite significant. So let me dive down into the US. I'm in the minority in that I think there are some significant headwinds facing the US economy. And some of it's coming from policy, like tariffs. And it's not just tariffs, it's the uncertainty around tariffs, the continuous changes to tariff levels. One of my industry contacts is a department store buyer. And so I like to ask them about how tariffs are impacting them. Now, what they've seen is good buying over the holiday season, but what they struggle with is tariffs and the continuous changes to tariffs. And I said, well, how do you handle that? Like, do you get bulletins from the government telling you what the new tariff levels are? And apparently not. They just go and scour the websites, the government websites, to see if tariffs have changed. They make sure they stay abreast of the news. I think it's very, very hard to run a business when you do have so many changes and so much uncertainty around tariffs. I think the conventional wisdom is that we dodged a bullet with tariffs. Obviously, the economy is so resilient that it hasn't been impacted by tariffs. But I would argue that it is being impacted by tariffs, but perhaps in ways we didn't expect. It hasn't cooled demand, but I think it has had a chilling effect on business investment outside of AI business investment, as well as hiring. In fact, if we were to look at the net jobs created last year, it was not a terrible year. It was not an enormous, huge year for job creation. We were a little under 600,000 net new jobs, but most of that growth occurred in the first 4 months. And what happened in the fourth month of the year? That was when we got tariffs. So I do think they're having an impact. I just don't think there's understanding of exactly how it's impacting the economy and a realization that it can be rather negative because it creates economic policy uncertainty. I think also immigration policy, if we see significant loss of workers, there are industries that will be impacted, especially construction, service industries. I think we haven't factored in just how significant the impact could be to the economy. There are a few think tanks that have done papers on this, and I think it's well worth reading it. And then finally, I would just say that in general, we are seeing, we will get stimulus from the One Big Beautiful Bill. And I think the expected tax cut is something like $1,000, an additional money back for the average taxpayer who files a tax return for 2025. But we have to keep in mind that a lot of those tax cuts are going to upper middle income and higher income consumers. And that tends to have a lower multiplier effect than the tax cuts that go to low income consumers. So we have to keep that in mind. It's not just about the actual amount of fiscal stimulus, it's the multiplier effect. How much of that tax savings makes its way into the economy? PPP had a very significant effect because it went into people's pockets and a lot of lower income consumers got it and then they spent it. Of course, that drove up inflation. That was another problem. But I think not all fiscal stimulus is created equal. We have to keep in mind those different multipliers. If we ask ourselves what powered the economy in 2025 in the US, it was really two critical things. It was AI CapEx spending, and it was an enormous boom. And then also high income consumer spending. That also helped power the economy. Some may have been to the US Open or heard about it, but the $100 chicken nuggets with caviar on them were selling like hotcakes. And I think that speaks to what we're seeing and who's driving, which consumers are spending and driving the economy. But there could be some speed bumps in 2026. For example, AI CapEx spending could slow if companies decide they don't want to invest as much. They're not realizing productivity gains. There was an MIT study that came out last year, and also the Duke CFO Journal came out in December and said most CFOs aren't seeing those productivity gains, or at least they don't know about it. So just something to consider. It's not going to stop AI CapEx spending, but it might slow it a bit. Also, difficulty getting funding to finance AI investment is a consideration. Production controls on rare earth elements. Keep in mind, we have to go elsewhere to get most of our rare earth elements and to get them processed. The refining process is a significant part of the equation. And then also NIMBY movements, not in my backyard. And with higher income consumers, we do have to worry that their spending might slow this year if, for example, we were to get some kind of a stock market sell-off or white-collar job losses, especially higher-end white-collar job losses. Thus far, what we've seen is really the job losses related to AI have been entry-level jobs. But what if they move up the food chain to higher-paying jobs? That could be problematic. And there are also additional headwinds for consumers. ACA premium increases. The average increase is over 100%, as well as wage garnishments for student loans in default. I think that's something that has been overlooked, but the Department of Education announced a few weeks ago that it would be garnishing wages or could garnish wages. There are over 42 million Americans with student loans, and I believe the average student loan is over $39,000. And I think I want to say over 60% are in arrears. So that could be quite problematic in terms of just, again, putting more pressure on middle and lower income consumers. So all in all, I think that the U.S. economy, while there are certainly some things that are going right, we have to recognize that there are significant headwinds there. And also, of course, the U.S. government is facing more budgetary constraints because the cost of borrowing is higher than it was. And so that also exerts downward pressure and makes it harder to have enough in one's budget to provide stimulus. So some things to think about. Now, of course, there is the potential for monetary policy to be supportive of stocks, but keep in mind that it's not just rates on the short end. What has historically been quite impactful is rates on the long end, and that could go in a different direction. I would also just argue that we need to be really thoughtful and careful about our US stock exposure. US stocks have done so well for so long that for many investors, they may be over allocated to US equities. And so this is a good opportunity to look at one's overall allocation and say, where am I overweight? And let me see if I can take some profits and allocate to other parts of the world, allocate to potentially other asset classes, as we prepare for a lot of uncertainty in 2026. One valuation metric that I just want to point to is the Buffett indicator. Warren Buffett made this popular more than 20 years ago. Many of you, I'm sure, have heard of it. Basically, the Wilshire 5000 relative to US GDP. And if it gets above 200%, Warren Buffett has described that as playing with fire. I would just say that that's an area where stocks arguably are priced for perfection. And so we have to ask ourselves, will we get perfection this year? And should there be should we give some thought to, again, diversifying and lowering exposure to US equities given how high valuations are? Now, interestingly, Europe, which hasn't been talked about for a long time, European equities had a strong year in 2025. And I think there's the potential to have another positive year in 2026. I think there are some real policy tailwinds there. Fiscal stimulus matters, and right now Europe is ramping up its defense spending. It's committed, European countries, with the exception of Spain, have committed to getting to 5% of GDP in defense spending by 2035. Germany is well on the way there. It should meet its target in the next few years rather than waiting till 2035. Obviously, there are very real incentives, and Europe realizes that it needs to do more spending and prepare more for its own defense, and that can be quite stimulative. The multiplier effect on, in particular, infrastructure spending, which is part of the defense and defense-related spending, has historically been quite significant. And so I think that is going to be stimulative to the economy. Remember, it's not just the stimulus dollars, the amount of the dollars, but it's the quality of those dollars, and the multiplier effect has historically been relatively high there. So something to consider. We're also seeing some academics. Europe is trying to lure some academics. They've had their research spending cut. A lot of research spending has been cut to US universities. And so academics and researchers are moving elsewhere. So it could actually be the source of innovation for Europe, which hasn't had a lot of tech or biotech exposure. So I think there's very real potential in Europe, and it's not priced for perfection. Valuations are relatively low. I think expectations are generally relatively low for Europe. I think investors think of it as very, very regulated, perhaps not as much potential, certainly not an exceptionalism story, but that could very well be changing. And so again, I would say this is an opportunity to look at one's portfolio and say, where can I take profits? And particularly in the US, given sky high valuations, and where could I go? And it doesn't mean, again, abandoning the US. It means being in balance. And again, if we don't rebalance on a regular basis, because of the strong performance for so many years, many investors are likely overweight the US. I think there's also some potential in the UK. The autumn budget was not the flop that many had dreaded. Sentiment is improving there, and they're also seeing some fiscal stimulus as it relates to defense spending. Now, China has both headwinds and tailwinds. I don't think it's something that that investors can entirely ignore. They just have to recognize opportunities there. Now, where China has seen some headwinds in recent years has been around consumer confidence. While it's improved in the last year, it fell significantly during the pandemic. I think there was a view that consumers in China didn't get the kind of stimulus that a number of Western governments gave, for better or worse. But that to me has been something that Chinese policymakers have been working on, and certainly are trying to provide pretty significant stimulus now. And I think that is why we've seen confidence increase over the last year. Where I think there's opportunity is in tech in China, where valuations are lower than US tech, and where there's some significant innovation. Of course, because there is something of a control economy in China, there is a lot of involvement and partnership by the government with private companies. Having said that, that has been something of a positive in terms of focusing on certain sectors. And in particular, when it comes to AI investment, it's been more methodical, it's been slower paced, arguably has longer legs. So again, an opportunity for diversification for those who have significant exposure to US tech. You don't want to abandon your exposure to US tech, but you might want to take a little of your US tech allocation and move it to a China tech allocation, just again to diversify. And then there is just potential in emerging markets in general, particularly Asia EM, where we're seeing some kind of key drivers of EM economies like AI CapEx spending, electric vehicles, robotics, semiconductors, and of course demographics in Asia EM ex-China is really impressive. Now, valuations are not low in all these markets. For example, the Indian stock market has a very high valuation, but a number of them have relatively low valuations and are quite attractive. And then there's an argument to be made for EM in general. I think we want to treat emerging markets not as one allocation. I think we want to be more precise and have Asia EM exposure, and calibrate exposures to other areas of EM, but certainly potential in Latin America, given infrastructure spending, mining spending, et cetera. So what I would say, as we look out on 2026, there is a lot of uncertainty, but there is also, I think, with uncertainty, there are risks, but there are also opportunities. And I would anticipate, given my concerns about the U.S. economy, I would argue that it's important for investors to recognize their risks, and again look at their allocations and ask themselves if they're comfortable, if they're overweight US equities. This could be an opportunity again to diversify and add to exposure outside the US when it comes to equities. In terms of fixed income, I think it's very important to be well diversified, to have some exposure to high yield, to investment grade, especially in Europe, where again, I think there's some upside potential. There are pretty low, arguably there are relatively low expectations. Now, one area that I haven't really touched on much, but I think is important to also be thinking about is commodities allocations. I am positive on precious metals. I think about the basket of gold, silver, platinum, and palladium as offering different characteristics for different environments. That's certainly what we've seen historically. Gold has for the most part been a hedge against geopolitical risk in recent periods, but it also has, if we were to look at down periods for the S&P 500. And in most of those corrections and in most of those bear markets, gold has held up very well, in some cases posting positive returns, in other cases posting very modest losses compared to the S&P 500. So there are arguably attractive characteristics that gold has exhibited in the past. Silver is starting to take on more of and I should say gold has become the premier safe haven asset class. We've seen over the last few years investors move more towards gold, and that includes central banks, and a bit away from U.S. Treasury, which had been the traditional safe haven asset class. But I think, as in all things, it's important to be well diversified. So having some exposure to silver, having some exposure to palladium and platinum, those are more pro-cyclical precious metals, ones that have historically performed well in more positive environments. Keep in mind, we could very well see a scenario where growth slows significantly in the U.S., but it picks up in other parts of the world. And so I think, having that exposure to a basket of precious metals makes, I would anticipate that could help provide diversification benefits, just given the track record of these precious metals. And then, of course, there is a place for alternatives. In my opinion, this is a time of great uncertainty. We could have another really strong stock market year, but we could also have some significant sell-offs. We could have a very risk-off environment. And so the ability to hedge through alternatives exposure is, in my opinion, extremely important. I look at it this way. Many of the things that occurred in 2025 were not on my bingo card. And so I have to ask myself, what's going to happen in 2026 that was not on my bingo card? So to me, the best recommendation is to have an investment policy statement, and to be well diversified and rebalance on a regular basis. But being well diversified means exposure to a broad range of equities, fixed income. It also means exposure to commodities, and in my opinion, it also means exposure to other alternatives that can offer hedges for what I would argue is a broader range of risks today than we've had in previous years. So I will stop there.
All right, Christina, thank you so much. We had a viewer here. They're wondering, are you bullish on gold mining stocks and silver mining stocks?
Yes, I think there's very significant potential there. It's not just about gold itself. It's gold mining stocks valuations are relatively attractive, and so I think that's part of participating in having exposure to gold.
All right, thank you so much. Another viewer here, they're wondering about the Man Group and if you had a quick overview and your position.
So I'm chief market strategist at Man. Man is an alternatives firm. We're the oldest publicly traded hedge fund alternative investment firm, and so we've had we offer a variety of different strategies, and we sub-advise, and we have several ETFs that can be accessed by investors.
All right, Christina. Well, that puts us right at time. Thank you so much for taking the time out. It's always a pleasure.
Thanks so much for having me, and thank you to all who joined us today.
Have a great one. We'll talk to you next time. All right, everyone. We were speaking there with Christina Hooper, Chief Market Strategist, Man Group. You're watching Money Show's Virtual Expo, your 2026 portfolio review. We're halfway through the day today. We have another day tomorrow. So thanks again for being here. Stick around. We'll have more content coming your way shortly.